without further ado, I would like to introduce Sunny Hamid to you, today my guest for the talk show. And Sunny is actually our company wealth management director for economy and market strategy in Financial Alliance. He's also the head of Financial Alliance Islamic Wealth Advisory, so to cater for our Muslim friends in Singapore and as well as Malaysia. Sunny has 22 years of working experience in the financial market. He has worked for companies such as S&P, and where he led a team of analysts covering emerging Asia economies. And he also worked for BNP Paribas before as a senior economist, and also S&P rating as a director in sovereign team, oversee the rating of countries such as Indonesia, India, Malaysia, and Singapore. So without further ado, I would like to invite Sunny on the stage. Let's welcome Sunny. Hi, Sunny.
Hi,
How are
thanks.
you? Hi, hello. Hey.
Thank you.
Yeah. So I just briefly introduce to all our friends who are probably watching now. Now we have about 187 are watching our show now. I hope that we can increase. So I just warm up, and then hopefully more and more people will come in, to the show. So so maybe Sunny, you want to actually briefly introduce a little more about yourself? I mean, yeah.
Okay, I will. Very good afternoon to everybody. Thank you for tuning in. Yeah, I know it's a Saturday, and typically you don't really tune into these kind of sessions, but I do appreciate it that you've taken some time off to come and listen to what we have to say. It is a bit of a off-the-cuff, informal type of sessions. This kind of, sometimes they have this kind of having coffee sessions and discussing between two people and then trying to pick ideas out of the person who's being interviewed. So a lot of the things that I will be actually explaining to you, it may be a bit, in an unofficial manner sometimes. We do have what we call seminars, which are official seminars where you get a little more structured type of answers. So I hope you don't mind when, sometimes I speak off the cuff and speak my mind. And so, but I think that's what you want in this kind of setting. So I guess we can take it away. I think very important is to share my ideas with you and to get also the questions that you may have, so I can probably give some ideas. Of course, I don't know the answer to everything, but where I can actually think I can add some value and give my point of view, of course, definitely I will do so.
Yeah. Sunny, I think there's one very important piece that I need to share also. There's a disclaimer so-called that, this is actually, just a sharing, because we can't actually recommend anything too specific, because there's so many of you here. If in order to have, the suitable solution, they have to go through their financial advisors. And this is just a disclaimer to mention about this. All right. So Sunny, probably we can start our show. And if, let's say, in the audience, if you have any question, if you want to ask, you can always put your comment at the so-called your Facebook page. We will monitor the so-called your question, and we will be able to ask. You will be able to ask Sunny as well, and Sunny can see your question as well on the Facebook comment. And I will start with the question first. Since today our topic is on market outlook, right? So my question is very simple, Sunny. I believe a lot of people also ask you about this, and my question is this: what is your outlook about the market?
Right. Okay. The million dollar question. Although nowadays no one talks about in terms of million, it's always now in terms of billion or even trillions. So anyway, the outlook question has always been the toughest, of course, to answer. Even more so in this kind of environment. Maybe before I answer the question, I need to explain a little bit about how I formulate my views on where I think the markets are going, because it may be different from some other people. I always feel, and I think a lot of, when you read some investment books, they will tell you that it is not a binary decision, which is a 1 and 0. If you think market's going up or you think market's going down, it's not as simple as that. Basically, you try and attribute a probability to what you think or where you think the market's going. Meaning to say that currently today, based on what I know about the markets, based on my assessment of the markets, I, for example, believe that there is a 70% chance of market actually going down from here and a 30% chance of market going up. So basically then behind these numbers, I have my reasoning why I think so, and so on and so forth. So basically the outlook is always a probability. and therefore thereafter you mold your strategy based on that probability. Because today I hear a lot of people either deciding to stay out because they think the market's going down, or to go all in because they think the market's going up. Basically, you only do that if you think it's 100% probability. Yeah. So the next time someone tells you that I think the market is going up or the market is going down, what I would advise you to do is ask the person, what probability do you think that event will happen? So if he says, I'm very sure, then ask him, do you have 100% of whatever you have in the markets? Because again, when you have a probability tree, meaning to say 70-30, your investments ought to be reflective of that probability, meaning to say, for example, 70% in bonds, 30% in equities because you think so, and so on and so forth. Yeah. So again, the outlook, again, as I mentioned, 70-30, 70% to the downside, 30% to the upside. And I have my reasons behind it. And I think probably we will probably go through these reasons later on, and I can explain them in more detail. But the outlook is a slight bias more to the downside than to the upside at this particular point.
Okay, Sunny, I mean, maybe it's also good to let the audience know about how we actually manage our so-called portfolio, because as you know, probably we need to also let the audience know that the way that how we actually look into a portfolio is not short-term, it's long-term. So probably you want to probably explain to the audience about the methodology and how we view about our portfolio.
Yeah, that's a good point, because I think people have to have the correct frame of mind. When I say something, then it has to be put into the context of that. Okay.
Right. Yeah.
Because we are a financial advisory firm, most of the time when we meet people, we are talking about financial objectives. And these financial objectives are very long-term. Either someone who wants to retire in 20-30 years' time, someone who wants to prepare his or her child's education in 10, 15, 20 years, and so on. So a lot of time we help these clients reach their objective by formulating a portfolio which matches the client's risk profile, and try and guide this client through the journey from now point A to point B in a manner whereby it is comfortable for the client. So basically, it is a long-term journey. The portfolios are not the typical in and out portfolios, because when you're investing long-term, you don't go in 100%, go out 100%. What you try and do is you try and ride through the cycles because markets actually go up and down, and you try and what we call mitigate and lower the volatility so that the client doesn't suffer this kind of large swings, either up and either on the way down. Yeah, so you want to have a smoother type of journey for the client so that he reaches his destination with a good return. But the journey is important. Because sometimes when you allow clients to sit through very sharp ups and sharp downs, after a while, it's very tiring, emotionally draining and stuff. So our work or our duty, our responsibility is to try and get the client to sit through the whole journey in a comfortable manner. So again, the way we manage money will be totally different from someone who says a short-term guy, or maybe even less than 5 years, or even worse, less than a year. Then a different mentality sets in. A trader will be in, out, trying to catch the bottom, sell the top, and so on. And someone who is a medium term up to 5 years may be a bit different, and someone like us, longer term, will be a bit more different. So there are different strategies, and people need to understand that, because it's not, people tend to think always it's just about coming out when you think the market is going down, and going in when you think the market is going up 100%. No, it's not actually like that.
Okay, yeah. So in the so-called introduction just now, I mentioned that you have 22 years in the investment in the financial market. So you want to share a little bit about about yourself, that your journey in this financial markets, investment market. Yeah.
All right, I'll try and relate that to what I do today. I've had the opportunity to actually be involved in many segments of the financial markets, and I consider that to be a privilege. I first started out in a dealing room, in a small bank, doing forex and money markets, and then I moved on to do technical analysis. So for a while, I was really a professional techie. Charting markets, doing the usual head and shoulders, trend lines, RSI, stochastics, and stuff like that. And then after that, my interest grew in terms of market intelligence, market information, and then I became what we call market analyst. I was talking to dealers and traders, mainly on the Forex market, understanding where flows were coming from, who was buying, why was dollar yen going up, why at that time, for example, Sing dollar was coming down, which entity had orders, that kind of thing. And then it became quite interesting to me that I wanted to move on. And because in my company, which I worked with, we had several divisions, those dealing in technicals, those dealing in the short end, and those dealing in the macroeconomics. And so we had what we call Dave Cohen, who I used to work with. He's passed away. He used to work with the Federal Reserve. So I got very interested in things that he did, which was studying the macroeconomics. And thereafter, I told myself that this is what I wanted to do. When we study and we come out, most of the time, we don't really know what we want to do. So I came out with a banking degree, kind of a general degree. But when I knew what I wanted to do and I wanted to be an economist, I went back to NUS to do my master's in applied economics. Okay. And thereafter, I moved on to become an economist. And after a while, I moved on to BNP Paribas Securities, where I did economics as a senior economist, but more on the equity side. So you can see that I actually moved from the foreign exchange side over to the equity side. And eventually I moved on to a company called Standard & Poor's, which did ratings. And if you know ratings is got to do with credit side or the bond side. So basically, I think I've been very blessed and privileged to have been able to go through the whole spectrum of FX, equities, bonds, and in between derivatives, and so on and so forth. So coming to a place where, for example, Financial Alliance, it's helped me tremendously because it's given me this ability to understand markets overall in a big picture manner, and also the various instruments. And that's where I apply most of the things I know to try and help our clients go through this journey, like I mentioned, in a comfortable manner.
Okay, that's good. So you used to share with me that during S&P rating, you also access to EPF Malaysia, right? You also look into the rating of the sovereign fund, right?
Yes, I was in the sovereign team, meaning to say that this is the team that actually does the ratings for sovereigns, which are countries. So countries under me were basically Indonesia, Malaysia, Singapore, India. That was my primary responsibility. Secondary responsibility was for countries like Japan, Thailand, Pakistan even, and so on and so forth. So it was a very good experience. I traveled and I met a lot of people, even central banks, IMF, World Bank, and people like that. So again, like I said, the background, I think I've been highly blessed to have been able to experience a very wide range of experiences.
That's good. That's excellent. So for these last 22 years, I mean, Bobby, you have actually experienced a few crises, right? So can you actually, it's also relate to outlook, the question of outlook. Can you actually relate this with the previous crisis, and what is the difference? What's the main difference, and what is the potential threat on this crisis?
Good question. I mean, I've sat through the 97 Asian crisis, 2000 dot-com crisis, 08 global financial crisis, and now today. Most of the time when you look at crisis, you would see crisis as it destroys demand. So it's demand destruction, basically. So basically what happens is, let's say 08 and even 2000, even 97, the stock market starts to fall. The currency peg starts to unwind in 97, and all this credit situation in 08. So basically it starts from the financial markets. And then what happens is that because this causes asset prices to go down, stock markets to go down, bond markets to go down, property markets to go down, it destroys demand. So there's a destruction in demand, which then leads to what we call a contraction in income, disposable income, and people don't spend. And we all know GDP is basically a function of spending. It's either government spends, individual spends, company spends. So it's because it's a consumption indicator. When people spend, when individuals spend, company or country spend, GDP goes up. So when there's a destruction in demand, GDP declines. Okay, so a lot of crises are focused on demand destruction. This particular crisis is unique because it also has led to what we call a supply destruction. So a supply destruction is where companies, because of a destruction in the supply chain or disruption in the supply chain, they cannot produce. Therefore, even though there is demand, although there's no, but even though there is demand, supply doesn't meet that demand because
Okay.
factories are not running at full capacity or even running at half capacity and so on and so forth.
Sure.
So basically, when you have both these things coming in together, that makes it a really unique kind of crisis where it's very hard to model. I can tell you, I've done econometrics before where we try and model things like, for example, where is GDP going? We use econometric models, we use regression models and stuff. I've done that before. And even when you try and do that on a country basis, give you an example, Singapore itself, you have to take into account variables like internal trade, external trade between countries, correlations and stuff. It's extremely difficult. And yet now today we have a situation whereby any model must take into account not only an internal dynamics, but external dynamics, and one which we have never seen before. Never in our lives have we seen countries shut down in such a acute manner, a severe manner like this. I mean, how do you model this into a model? It's extremely difficult. So I think this also leads me to a reason why I think there's a higher chance of markets coming down and going up, because I think the market, to a large extent, doesn't understand this. Meaning to say, it's underpriced, it's under discounted the fact that this thing can continue much longer and much deeper. So, everybody tells me that the market is a discounting mechanism, which I totally agree. I mean, as if you're in the market, market actually bottoms out ahead of a recession. Market actually moves ahead of particular events and stuff once it knows the event. But you must also understand that market is not a perfect discounting mechanism. There are certain instances where the market is imperfect in its discounting ability. I'll give you an example, which is at turning points. Markets are always off the mark when it comes to turning points, because why? Market always uses what we call the previous trend line or the previous regression line, and it starts to project up forward. Okay, so when markets start to turn, economists or strategists will start missing it until they realize that it actually is turning. So for a period of time, it goes off track, i.e. market expectation and actual reality. So turning points are where markets typically get it wrong. The other place where market gets it wrong is when the market doesn't understand something. And when I say that, it's most likely something that's not related to finance. And this was the case early this year in January and February, whereby everybody in the market said that, wow, whatever's happening in Wuhan now is just basically something like SARS, or basically something, which is no problem at all. It's just going to be confined, because the market isn't in tune to the medical side of it. You will find a few people who, even in January and February, and these are market people, hedge funds and stuff, they already did a deep dive into the situation, and they realized that once this thing moves out offshore from Wuhan, it's unstoppable because of the way the thing is actually spreading, and the R0 of 2 and so on, so on, so forth. So a lot of things that's being discussed today in the market was actually known in January and February, and people who knew that used that to their advantage in the market itself. So again, what I'm trying to say is the market sometimes, while it's a discounting mechanism, it doesn't necessarily know and understand 100% of the time. And that's why today, I don't think the market understands fully the impact of COVID-19 with respect to the lingering effect. Everybody's just focusing on, okay, when August comes, everything's going to go back to normal and so on and so forth. But I think it's more than that. It's going to be deeper and longer. Everybody's harping on a vaccine. When the vaccine comes out, everything's going to be fine. But time and time again, when you look through the videos, the articles and stuff, the individuals involved in doing these vaccines will tell you that it is actually 12 to 18 months, 12 to 18 months, 12 to 18 months. And yet you keep hearing the market saying, don't worry, it's going to come out. We've just got news that a vaccine has been found, or they're trialing a vaccine. If you really know about trialings of vaccine, you'll know that it starts off in a petri dish, then it goes on to animals, then it goes on to single individuals, then it goes on to a smaller group of individuals, then they are randomized blind tests and so on and so forth. It is really a whole big process. And after that, you have a situation whereby they have to crack their heads. How do I produce enough vaccines for 7 billion people in the world? Which is another thing. So that's why people who know about vaccines, I'm not saying I know, I just read what people write. It's going to be 12 to 18 months. So, I don't think the market's harping on something before Christmas, but I think that hasn't been discounted that the vaccine is actually going to be much later than that.
I see. Sunny, there's question from the FP, our FP
Yeah.
friends.
Yeah.
There's one of them is hi, Mr. Sunny. What do you think are sign or signal that would indicate market are starting to recover? Okay.
Yeah.
So
I mean, the thing about this market is basically there are several moving parts. Okay. If I were just to look at it from a technical perspective, and most times when you look at the crisis, you will see that they tend to go through these kind of phases. So we are now currently in a phase whereby there's still optimism. There's still people who have cash by the sideline coming in to buy because they believe that this is the bottom and they'll expand their cash and use their cash. If I'm right and there's a 70% chance of market coming down, that also means that basically when the real economic impact starts to seep in, demand is not going to come back as fast as this. Shops are not going to open. Revenue for corporations are not going to go back to 100%, so on and so forth. The market takes a new down leg. Okay, when the market takes a new down leg, that's what we call, if you know technical, the third wave, basically the biggest one of all. Okay, and the market tends to consolidate a little bit, and then we go through what we call the final phase, whereby everybody just throws in the towel, sells it, and that was basically the January, February, March of 2009, where everybody just kind of lost hope, despondency, and so the cycle of emotions. That would be one indicator. Okay, so basically, the reason why I take technicals, and some of you may ask, why is it so? Why focus on technicals, not on fundamentals? Because if you study charts before, charts are basically used when you don't know any information or you don't know the full information in the markets. Because I may know something and someone may know something, but I don't know what the other person knows.
Yeah.
So that other person who knows will act in the market by either buying or selling. So he will incorporate his knowledge into prices in the market, and then the price will move. And then I'll see the price moving. I say, what's going on? Oh, maybe it's due to someone knowing something I don't know. So why technicals are more or less important, and we take it as part of our analysis, is because it incorporates a lot of the information that you and I may not know. Because information is imperfect to everybody. Okay, so based on that, if today I said something like, I think the vaccine may be 18 months, but out there someone may already know that it's actually going to come out in 6 months, and he's absolutely sure of it, and he acts on it. So the market will start turning up, and then I will have to then reassess my situation, because why is the market turning up? So basically what I'm trying to say is, in this situation, indication would probably come from the chart price movement more than news, because there are a lot of news that we really don't know about this time.
Correct. Yes. Sunny, yes. Just pause a while, because I hope that all our so-called our viewer now who are actually now watching our so-called show, please share out the link if you think that this session so far is so good that you get a lot of insight from Mr. Sunny Hamid. Please share with your friends so that more people can come in and maybe learn from each other about market outlook, and also later Sunny will also talk about the strategies as well. And there are also a few other questions coming in. So let's see the other. Okay, right issue. Right, for right issue, is it better to sell the rights or subscribe them?
It's a bit difficult for me to say, because right issues are specific to a company. So it really depends on the company. But I can tell you roughly, for a company itself, you would want to own companies which are of better quality, of good quality, companies which are, number one, good cash flow, number two, strong balance sheet, number three, have unique products or selling proposition, and so on and so forth, because we are in a deleveraging kind of environment where there is going to be a very high, unprecedented level of defaults. You really do not want to hold on to companies which could face a default risk. Okay, so one way of looking at it is if you see any companies and they have a rating, then basically anything in the A category is something that you want to hold. Again, this is just one variable. It's no guarantee, but it helps to give you some level of comfort because there's some quality. A third party has done the assessment. The third party is a ratings agency. Okay, so basically it really is a company to company level whether you want to subscribe or not subscribe.
Okay. There's another two questions. Will government run out of resources to fund stimulus package?
In theory, no, because in theory the government is always able to do two things. One thing is, of course, to raise taxes. No one else in the world, no one else in the country can raise tax. So when the government raises tax, the government is able to use that tax money to fund its projects and fund its stimulus and so on and so forth. Of course, there are implications on what we call disposable income because of that. So the second one is probably the preferred way of doing it, which is to print money. So printing money, you can print money in an unlimited manner, QE infinite or QE unlimited. However, there's no free lunch. So there will eventually be a repercussion on unlimited quantitative easing. For example, in the US itself, when you go through unlimited quantitative easing, what you're doing is you're printing as much US dollars, and what you do is you go to the markets, you buy up all the toxic assets, you buy up all the municipal bonds, you buy up the treasury bonds, you buy every bond that you can get to support the bond market. In return, you inject the liquidity, because when you buy bonds, you give the bond seller the money. So that's an injection of liquidity. So in the central bank's balance sheet now sits all these bonds, and that's why if you go to the Federal Reserve balance sheet, you see it's a straight line up, okay, because they've just taken on all these bonds. That's not the role of a central bank. The central bank is basically there to iron out inflation, to make sure growth goes. It's not to support the market and take in all these kind of toxic assets and stuff like that, because it's now taking on market risk. Can you imagine that some of these bonds, the central bank now has all these municipal bonds, junk bonds, BBB bonds and stuff. As we go down this recession, some of these bonds will default. And who loses money? The Federal Reserve, because it sits on their balance sheet. And so therefore, there could be a loss of confidence because of that. That's number one, because the Federal Reserve now is doing that. There could be what we call misallocation of resources because there's moral hazard. Everybody believes the Federal Reserve, no matter what, will come and buy. So never mind, I just go and buy all these junk bonds outside now because the Federal Reserve will bail me out forever, which leads to what we call bubbles in the situation. And we all know it doesn't end very well. With all this pumping of liquidity into the system itself, eventually it will lead to high inflation, which is one of my scenarios. I think we could be moving into a situation of what is called stagflation, high inflation and low growth, which is caused more or less by Federal Reserve and many central banks printing money. So all of this has no free lunch. Eventually, it will lead to what we call repercussions. And I dare say, had the Federal Reserve allowed not done quantitative easing in 2008, then the markets and the asset prices would have deflated, okay? So much so that then when we come out again from 2008, it would have been a cleaner situation. Instead, what we did was Federal Reserve prevented a clean out of the balance sheet in 2008, inflated it even more, and today this is the repercussion. Okay, so there's a reason for recessions. Recessions are basically periods of time where the markets or the economy says, we've gone through a boom, let's now clear out the excesses. If you try and prevent a recession, you are just building up the excesses bigger and bigger and bigger. So when the time comes, you cannot stop it. It's going to be a big nuclear explosion rather than a small bomb. Okay?
Okay, there are questions coming in. So there are one, Mr. Sunny, is your view on US Sing dollar movement?
Okay, so basically today what we're seeing is we are seeing the dollar strengthening. We're seeing the dollar strengthening because technically speaking, there has been a dollar squeeze. 60 to 70% of global trade remains in dollar. There is outside of the US a bunch of massive amount of dollar debt being issued. Malaysia issues debt in bonds in US dollar. Indonesia issue bonds in US dollar, and everybody issue bonds in US dollar apart from issuing bonds in their own respective currency. They issue in US dollars. Okay, do you know that those issuances outside of the US in US dollars, when you issue a bond in US dollars, you need to pay the coupons in US dollars. If I'm Malaysia, I issue a US dollar bond. the holder of my US dollar bond will receive coupons in US dollar. Malaysia, have to go and find that US dollar in order to pay back, to pay my bondholders that coupons. That's, I think it's about 13 trillion worth of coupons of the dollar that's needed to pay all these offshore dollar denominated bonds. That in itself is dollar demand. So there are a lot of people who believe that the dollar itself has this natural bottom or floor because a lot of people need to get dollars because of either trade purposes or because they need to pay their US dollar denominated bonds, which is very true. And therefore, what we saw in February and March was when all these things started to unravel, everybody was saying, I better just go and get all my dollars first in case, because if anything comes out in the next couple of months, I may not be able to find the dollar. So there was dollar squeeze, and therefore the dollar started to rise against every single currency in the world. Okay, but okay, there's a but to it. but if I'm the Federal Reserve and the US government, I would actually want a weaker dollar, because on one hand, I'm easing monetary policy to help my economy. On the other hand, I'm actually expanding my fiscal policy in order to help the economy. I really don't need a strong dollar to offset what I'm doing both on the monetary and fiscal side. I need a weaker dollar. So there have been points in time in history, the Plaza Accord and so on and so forth, where the dollar just got too strong, and the US itself and also countries around the world came together to intervene to bring the dollar down. So I would not be surprised if the dollar starts hitting levels in the dollar index itself above 100, 110, and so on and so forth. You will find that the US, maybe together with a group of G7 countries, coming in to actually intervene to weaken the dollar. So I won't actually rule that out.
Okay. All right. So another question. There's a few more questions coming in. So that's good. Keep the flow coming. So Sunny, you can see the question as well, right?
Yes, I can see. So Jeffrey is asking about the Hui Index. For those of you who don't know, the Hui Index is actually it's called the Gold Bug Index. It is actually an index which represents the gold mining companies available mainly in the US, I believe, New York Stock Exchange. Okay, so there's physical gold, there's a price of physical gold, and there's a price with regards to gold mining companies. Okay, the difference between physical gold and gold mining companies is physical gold is very clear cut. The price of gold goes up, goes down, it's the commodity itself. When you talk about gold mining companies, you have basically the balance sheet. You need to see gold mining companies, when gold prices go up, is good for gold mining company revenue because revenue goes up. Because revenue is tied to, I have 20 tons of gold. Now gold prices has moved from 1,000 to 2,000. So my 20 tons of gold now is worth more. Revenue goes up. But miners have this other component which is called cost. Okay, the cost component sometimes actually is detrimental to the gold miners. Sometimes it's actually a positive. It's detrimental. Give you an example. After 08, 09, 2010, gold prices went up a lot. Okay, and because gold prices went up to 2009 back then, it prompted a lot of companies to try and search for new gold mines. They were looking for the El Dorado, you know, that story about this mystical gold mine in the middle of the Amazon and stuff like that. So all the gold miners were going, they made money. Instead of passing back the money to shareholders, they took the money for exploration in the middle of Africa, in the middle of Central America, in the middle of Amazon, and so on and so forth. And I think I've read the studies before, 9 out of 10 such exploration went down the drain. And when that happens, you basically burn the money that you spend. Rather than give it back to the shareholder, you just lost it in exploration. Okay, so that was what happened. So gold miners have this kind of cost aspect, yeah, which deviates or decouples it a little bit from the gold price itself sometimes. Okay, the current situation. Okay, the current situation is one. I think gold prices are going to go up. Currently, although we see gold prices moving on a 5-year high, if you go and look at the gold prices itself in terms of not the US dollar, but in terms of your own currency, Sing dollars, ringgit, or wherever you are from, you'll find that most of the gold prices in local currencies have already gone to historical highs. It's only the US dollar which hasn't gone to historical highs. I think in Sing dollar has really moved into historical highs. Basically, what it means is that basically there is this demand for gold. Gold itself can go much higher, in my view, not only because of the printing of money by the Federal Reserve, because people now also feel that they need gold to be part of their portfolios, okay, in order to insure their portfolios, okay. But the cost side of the miner, and we talk about the Hui now, is also very interesting. Revenue is high. Cost now for the miners is actually coming down because 50% of cost is made up of energy, because it takes a lot of energy to mine to get 1 ounce of gold. And 50% of energy comes from oil related. And given the price of oil today, you will see that basically what I'm trying to say is we have a situation where the miners have increasing revenue because of increasing gold price and decreasing costs. So their margins will actually start going higher and higher. It is already going higher and higher, okay? Except that now some mines are closed because of the quarantines and stuff. But you will find that demand is very high. For example, gold coins itself totally run out. There's just a news coming out today that, or today a few days ago, that in the US itself, they are starting to ask Perth Mint in Perth, of course, Perth in Australia, to ship more and more coins over because people are just taking it off the shelf. So my view is that we still have a huge upside for gold. I would play on the Hui index, meaning to say I will use gold miners. Don't buy one single gold miner because again, there's always a default risk. Buy a basket of gold miners using a unit trust. Why the Hui index? Because traditionally, gold miners have moved 3 times more than the gold price. On the way down, you don't want to hold gold miners because you lose 3 times more than the physical gold. On the way up, you want to hold on to gold miners because gold miners go up 3 times more than the physical gold itself on average. Okay. Sorry,
there's many questions coming up. So this gentleman here, Chi Wee, right? So he mentioned about he agreed with you. So he asked whether is this a right time to invest now?
Okay, let me see the question. I guess the stock will go down further and probably hit now. So do you agree with me if I assume that there's still not the right time to enter the stock market? Thanks in advance. Okay, that's actually a good question. And that would bring me to my 70-30 view, correct? 70-30 view means 70% belief that the markets are going to go down, 30% chance I may be wrong. Why? Because I think that, who knows, the market could still be irrational. Meaning to say that just because the Federal Reserve has actually given unlimited quantitative easing and thrown the kitchen sink and so on and so forth, that market now believes that no matter what, it's fine, don't worry, And these things happen. I'll just quote you an example. In 2016, the market was about to roll over. Look at any chart. You'll find that the market was almost like a topping kind of scenario. Because why? If you look at that point, all the economic figures were turning negative. Earnings were turning negative. Every single thing in the market told you that basically the economy was weakening. Okay? And then guess what? In late 2016, if I remember the US election, and at that point there was Brexit and there was a US election. But when Donald Trump came into the picture, he did a few things. He cut taxation. He brought back repatriation. He did infrastructure spending, the famous 1 trillion infrastructure spending. And market took that as a signal to rush back in what we call the fear of missing out, FOMO. And the market just went up in 2017 in one straight line up and stuff like that. So what I'm trying to say now is, as much as the macroeconomic data, and I believe that markets are probably going to come down, there's always this possibility that what the Federal Reserve did today, means to say the unlimited quantitative easing, may just be able to trigger investor psychology to just go the other way. Okay, so basically, if we were to say that let's hold back everything today, let's not invest because we think the market's coming down, then you must have a plan if the market starts turning up. Because if the market suddenly starts turning up and you are not invested in the market, you need to jump back on again, because then you have to say, I got it wrong. And this market is now acting in a way where maybe it's irrational, but if it's going up, I need to jump back on again. Okay, so you need to make that decision, because if you're not in the market and you think the market's coming down, always prepare for the unexpected. The other way, of course, is what we are trying to get our clients to do is, since we are 30% not sure whether the market is going up, but 70% sure that it's coming down in that sense, why don't we adopt something called a dollar cost average? That means we start, say, 18 months. Okay, whatever you have, if you have $18,000 to move into the market, let's put in $1,000 every month. So we start off this month by putting in 1,000, putting in 1,000, putting in 1,000. So two things can happen. Number one, market goes down based on our 70% expectation probability. What will happen is we are buying into a lower and lower and lower price. Will we get the bottom of the market? No, because we're not buying a single price. But will we get a nice average, which we hope that it will be near to the bottom of the market? Highly likely, because we are averaging down over a long period of time. Okay, so have we covered our downside scenario? Yes, I think we've covered our downside scenario. If the market suddenly starts to turn up, and I've gone in my dollar cost averaging 3, 4, 5 times, at the very least, I've got my 4 or 5 bullets in already, and the market starts to turn up. So I don't have to be, in the lack of a better word, kanchiong, like, oh, market is going up and yet I don't have anything in. It's a totally different feeling. When you have something in already, then you have time to assess and you say, okay, now let's take a deep breath and say, is this something which is short term, or if this really is something I think is a long term, should I start bringing my unused bullets, unused dollar cost averaging, forward it and bring it in now straight away, or should I just continue the dollar cost up? Yeah. So that's why we think that dollar cost averaging is the way to go, because it kind of protects you to the downside and also protects you to the upside to an extent.
Yeah. Okay? So there's one question. There's one question about DCA. So I think you have addressed the answer for that DCA.
Okay.
Somehow it's now. Yeah, she asked about DCA and now lump sum. So I think you have actually explained that pretty clearly. So there are a few more questions. So I do have some questions to you later, but maybe we
answer the questions from the participants. Yeah.
So this one is from Belford. Belford, do you have any views on recent collapse of oil price and how to capitalize it?
Okay. Admittedly, I'm not in the oil market in the sense I'm not an expert, but I do read a bit about the oil market. Okay, so a few things is, one is the oil price itself, I don't think will recover very swiftly. If anybody's expecting oil price to move to 50, 60 over the next 6, 7, 8 months, I don't think so. That's not my view. Because when you read what people are writing, everybody is in agreement that demand has been destroyed, supply has been destroyed in a sense. Okay, so meaning to say, first, there's no demand because of the lockdown, because of the slowing economies. Global growth is going to go into a recession. Automatically, there's not going to be a lot of demand for oil, naturally speaking. Okay, but the supply side is a more interesting one. So the supply side, I think you all know now, recently news have come out that the storage capacity is being run down all the way down to almost zero, meaning to say, when the refiners are refining oil and producing oil, they need to keep the oil somewhere. If you're not buying it and you're not consuming it, it means I have an oversupply. So I keep it first in my storage tanks onshore, on land, those big bunkers, big storage. Then I can also keep it in some of my pipes and stuff like that. If I run out of that, I keep it in ships, tankers, which are now sitting right offshore, not sending oil to me, but actually just storing oil there for me, because I have nowhere else to put. And that was the reason why we had that huge decline in the futures price. That's another issue. Okay, but anyway, so what I'm trying to say is, even if the global economy starts to pick up and demand starts to pick up, demand then has to settle this oversupply situation. It has to dry out all these tankers that's lying offshore. It has to empty out all the storage facilities that's onshore today, okay, and so on. So basically, there are supply impediments which I think, even with an increase in demand, will prevent oil prices from normalizing for an extended period of time. So I don't think any oil price will move up very high in a short period of time. But are there opportunities? I guess it's in oil price, if I don't see oil prices moving up, then therefore buying oil price itself, buying an instrument that targets oil price may not be the way to play it. Maybe the way to play it is basically to target what we call the big boys, the stronger companies in the oil market. Because again, the shake through that we're seeing, not only the oil market, in many other industries, the first thing that you want to, if you're targeting to go into equities and to buy up some of these guys, is basically who will survive.
Yeah.
Because we are going to go through again a deleveraging and stuff. So a lot of people will die. I mean, lack of a better word, will die off. And the big boys are the ones who are left with the capacity, ability to start gobbling up some of these people whom last time may be too expensive, now cheap. So I think what it will cause basically a consolidation in many markets, and we will see a lot of companies, the one that are able to survive, just become extremely strong, because now they corner. They've taken like 70% or 80% of the market because some smaller guys have gone off. Yeah, so maybe you want to play it through buying some of these oil shares or oil companies, but again, maybe do it through a unit trust, because why? You don't want to end up buying someone who goes down because you can't tell. So basically buying a basket would be much better.
Okay, so do like and share, like our Facebook page, and also share out this link as well, so that to invite more people, because I have another 1 or 2 questions to Sunny later about the opportunity and also your strategy. So also to let everyone know that, if you sometime look at Sunny now, it's quite familiar. Why? Because he's often been actually invited to be interviewed by Channel News Asia on his view on market, or CNBC. In Singapore as well. So don't be surprised when you watch TV, sometimes you see Sunny Hamid on TV, right? So Sunny, maybe there are a few more questions, but I just want to go to another question of mine that, because of time, it's quite fast. But I think it's good because the audience like to ask a lot of questions, which I think is good that they want to know more about this. And I want to ask you this question about, with so many discussions just now and so many views that you mentioned just now, what are the investment opportunities then? What is your view on this?
Well, there are many investment. I know it's hard to believe that there are many investment opportunities, but they are. You just have to be very careful when you approach it. I saw someone ask again about Go. I'll tell you, Go itself, for example, if you we have a YouTube video on Go. Please go to our YouTube channel, Financial Alliance YouTube. I've made a video on Go. I've shown how Go price correlates negatively to what we call real interest rates. Real interest rates means interest rates minus inflation. As real interest rates collapse, gold prices go up. So that's an investment opportunity. Because why? Because I think nominal interest rates are going to come down for certain. But it's happening already. And I think inflation is going to go up. So real interest rates is going to collapse. And if you look at the chart and the correlation in that chart, if real interest rates collapse, gold prices go up. So that, in fact, is an investment opportunity from my perspective. So that's number one. Then number two is other investment opportunities is, for example, if you are a long-term buyer of equity, then you would adopt what we call the Warren Buffett way of investing. Now is the best time for you to start picking up good value stocks or companies which will still be around after the crisis. In fact, will come out stronger, like I say, because now they start to gobble up everybody else. So don't pick the bottom, because you don't know where the bottom is. Now the time to maybe dollar cost average, to start buying a little bit, buying up a little bit, buying up a little bit, and start collecting. So you get a good average. And then after, when the market picks up, you're there already. Okay, so, but if you are looking to come in and out, in and out, in and out, if you're in an equity, the volatility will kill you. I guarantee you that, because that's what happened in crisis after crisis after crisis. If you're a bond investor, where are the opportunities? The opportunities are basically in good quality, maybe the front end, AAA government type bonds. Okay, so basically I would move or I would look into that particular segment because you have to be very careful. Again, there's this thing about the triple Bs. Again, I have a YouTube video on that. Why the markets actually fear this triple B situation, junk bond situation very much. There's a video on that. So I would avoid that part. So in every asset class, including private equity, we have a private equity which I have a strong belief that it will continue to give double-digit return regardless of what happens in the market, because it's considered to be non-market correlated investment, doesn't relate to the market. So in every asset class, you will be able to find opportunities. The question is, you need to pick them well. because it is a very tricky environment.
When you say non-market correlated, what is that? What does that mean?
So traditional markets are stocks and bonds. Okay, so a non-market correlated investment, for example, could be private equity, whereby this fund doesn't invest in the public equity which is listed on the stock market. So if the stock market goes up and down, doesn't really matter. So I invest in the private equity. So basically, it's not market goes down, it just continues to do whatever it's supposed to do. There are certain non-market correlated investments which are by structure, long short equity. The fund manager goes long on and short equity, so there's no correlation with the market. The market may go down and this guy may still make money because he's doing long short. Yeah, so these are what we call non-market correlated investments.
I see. Okay, there are questions. Maybe we answer one or two that is interesting one. So okay, there's one of them which is with US election is near future. Will it distort your 70% bullish view?
Okay, I can't see. Oh yeah. Good question. Donald Trump winning used to be or was interpreted as a positive thing, and the odds were that he was going to win prior to COVID-19. So basically, the market was expecting him to win, and the market was bullish if he wins. Okay. Why? Because Donald Trump is someone who will do anything and everything to keep the stock market up, because he sees that as a reflection of his presidency, and of course he's a businessman. He has interest in it. Okay, so from a market perspective, Donald Trump is a positive. However, with the current COVID-19 situation, if you look at the opinion polls and stuff, he's lost quite a lot of credibility because of this. The way he's approached it and the way he continues to make a mockery of himself. Please don't go and inject yourself with disinfectant. I'm telling you, it doesn't work. Okay. So all of these things now has thrown the election into a bit of a turmoil. Meaning to say, we don't know who's going to win. Joe Biden may win, in fact, now, because we're not pretty sure about this whole thing. Okay. So if Joe Biden goes in, then I think the market may not be that positive. Okay, although not as bad as Bernie Sanders and some other guys, but still they see Donald Trump as someone who would push for the market to be more positive, and they're a little bit uncertain with Joe Biden. So again, it could distort. I hate to say this. It could distort my 70% view if Donald Trump wins, which I don't want him to win. But it could be that case. Yeah. Okay. Anyway, I hope I tried to answer your question.
Okay. Yeah. So actually, we hope that we can hit 300 people. Now we have 250. Just now up to 273 viewers. So what you can do is very simple. You just hit the share button. There's a share button at the message there. You just hit the share button so that share out to more people, and then like our show as well, so that we know that you are getting so-called good insight from our show as well. So please share and like our so-called show. Because of time, Sunny, I just want to ask you this last question.
There's one question here is quite interesting. If I may answer that,
okay.
if you don't mind. That's the one on the Teo Hong Kim from Teo.
On the ETF.
There's some people who talk about ETF bubble. Do you think based on current situation it might trigger it? It's an interesting question because it has already cropped up in a few places. You see, the ETF bubble, for those of you who don't know, is basically this. There has been a lot of move away from what we call active management. You give money to a manager, you pay the manager 1%, the manager invests on your behalf. Okay, there's been a move away into passive, which is ETF, i.e. there's no fund manager. When I take $1 million out from my fund manager, okay, and I give it to a passive fund, all that fund does is take that $1 million and start to invest in the index-linked stocks. Just give you an example, STI. STI is made up of, I can't remember suddenly, 30 stocks, if I remember correctly, the 30 STI stocks. Okay, if I take $1 million away from an active fund manager and I give it to a Sing STI ETF, that $1 million will only be allocated to that 30 index-linked stocks, which means that my index-linked stocks will go up. And as more and more people withdraw from active to passive, that index is just a vicious cycle whereby it will just continue to go up and go up and go up. Because why? Because an ETF does not care whether my STI, Singtel, OCBC, DBS, the PE ratio does not matter. Does not matter. Because all it knows is you give me $1 million, I deploy that $1 million into an index-linked stock, regardless. Whereas an active guy, an active fund manager will say, no, I'm going to hold back a little bit on DBS because PEs are high. I'm going to hold back a little bit on Singtel because PEs are high. So that doesn't happen in the passive fund. So the bubble here that Theo has referred to is the fact that a lot of these markets may have been propelled higher because of this switch from active to passive. Okay. What has happened over the past couple of weeks is we've had blowouts in the ETF, some of the ETF instruments. Some of them because, for example, in the bond ETF itself, okay, ETF allows individuals like you and me to go and play the bond market, which typically is not open to us one. Because bonds are sold on tickets of 1 million each. But now with $100 also, we can go into the bond market. So there's been this huge rush of money that's moved into the bond market, okay, especially the high yield and stuff like that. Okay. But when you come out, it's stuck because too many people, the exit is so small. And that's why the Federal Reserve had to go and support the high yield bond market, corporate BBB bond market, some of them via ETFs. That's why we saw a blowout on the ETF oil market, although there's slightly different reason for that and so on. So the contango and stuff like that. What I'm trying to say is I do agree with you that many of these asset classes have increased because of the huge amount of money moving in via this incredible instrument called ETF. But ETFs work both ways. Imagine today if someone withdrew $1 million from a STI ETF, it means $1 million worth of selling will be concentrated on 30 index-linked stocks, not any other stocks, but 30 index-linked stocks. So that is cause the STI index to go down because the selling has been concentrated on only 30 stocks. So there is good to it, but there is a price to pay on the other end. So yes, I'm worried about it. I think it will cause a lot of volatility, and I think that's where investors have to understand this much more. Okay.
Okay, so maybe I would like to ask you this question. Okay, going forward because of this, what is your strategy to invest now?
Yeah, so basically, I think I mentioned it to a certain extent. If there are certain asset classes where visibility is good, like I mentioned Go, and I made the argument why I think Go based on real interest rate collapsing and stuff, then it's straightforward. I'll go in, buy a Go unit trust, make sure that my Hui miners, I have a bunch of Hui miners, okay, and therefore, so I mitigate my default risk because I'm holding a well diversified pool of miners, and then because my Go view is positive because of collapsing real interest rates, I write that bet. Okay, so that's a direct bet. So, but when it comes to equities, then it's different because I think that equities are coming down, so I'm going to use it as a opportunity to pick up good bargains, which I think will do very well further down the road. So, slightly different strategy for equities. For bonds, slightly different strategy because I think market's going to be volatile. I need to push everything because right now, I also have this mantra, which is there is a time where not making money is losing money. It means when the market is going up and you're not making money, it's as good as losing money. There is a time for conservative investors where not losing money is making money. So basically, this is the time because if you're conservative, you can't take the gold risk, you can't take the equity risk. You need to try and consolidate your bonds so that you don't lose your capital. And so different people, different asset class, different strategies.
Okay, there's a question here. Can you explain what is the core portfolio? What is the tactical approach in investing, and what is the tactical approach in investing?
Yeah, okay. So basically, you know, it's just one way of investing. Some people, what they do is they build a core tactical or core satellite approach. Tactical means so they put 60 or 70% of their investment into what I mentioned just now. Those companies which they feel that will do well despite this crisis. Good time to pick up coming, and they will come out from this crisis stronger. So you start picking when I see opportunities, I'll start picking the Apples, the Microsofts, whatever the case is. I'm just mentioning names. I'm not trying to advise, but I'm just saying these are good companies if you feel maybe that it will come out from this crisis. Okay.
Yeah.
Then that's only 60-70%. What do you do with the additional 30%? Then I plug in my view on gold. That's a tactical bet. Then I plug in my view on something else. That's a tactical bet. So you have what we call a core holdings and a few tactical bets by the side. It could be 70-30, it could be 60-40, it could be 80-20. Really, that's depending on the risk profile of the client.
Okay, there's this question. This one I want to ask you this question, but there's one audience is asking now. What is your view on REITs funds?
We have a REIT expert in Financial Alliance, a very well-known person. Probably he'll be more. Yes, we have a lot of questions on REITs. You should do something on this with Kenny.
Okay.
He is our specialist on REITs. He's one of the gurus in terms of REITs in this market. I have my views, but I think he has a better view of the situation on REITs. What I can say is you need someone to guide you, because like all the markets I mentioned, you need to be very selective because it is an unprecedented time. Things will change. And your question basically alludes to the fact that you're wondering, will rentals continue to hold up? Because people are now so used to shopping online, no one's going to go back to the stores again and stuff like that. Which again is a valid question. Many people have asked, and I think our colleague Kenny has a good answer to that. But my coming from an asset allocator perspective, and I do more macro big view, is that these things are good to have on a tactical basis to keep it there. So you may want to put someone say core holding. REITs could actually be a core holding, because you can slice and dice it in many ways. You could have something that you feel that actually this thing, I don't mind holding it for the long term, even though it's a REIT. Long term, it gives me stability and I think the distribution will be good, so I keep it. But I can also have some tactical ones, which is, I think this one may do well. Maybe the data centers may do well because this is going to continue much more. So I'm going to take a bet on the data center. So part of your risk could sit on tactical, part of it could sit on core, or vice versa, or whatever the case is. But again, for the whole REITs big picture, I do ask you to invite Kenny and talk to.
Sure. There's one question about gold investment. Bear with us, because at the end of the session, we will actually introduce and let you know that we will have a upcoming webinar, so that you can also register for the webinar. So because there's many questions, I think it's good that if you can stay for another 5 minutes, so that we can actually wrap up the session. But there are questions are coming in. So there's one more question that probably you want to answer for gold investment.
Yeah, I did answer to a certain extent. The answer is now funds. Why? Because if you look at the history between gold funds and physical gold, the gold fund, which I'm using the Hui index as a proxy, it moves roughly 2 to 3 times compared to gold price. You don't want to own a gold fund at the top of the market, because it's going to go down 30% when your physical goes down by 10%. You want to own a gold fund at the bottom of the market, because when your physical goes up by 10, your gold fund goes up by 30. So that's the point now today. I wouldn't buy an individual gold share like Barrick or Newmont or stuff like that, because you're afraid of default risk. So I would buy into a gold unit trust which holds gold. What you need to do is, when you see gold unit trust, there's several different gold unit trusts in the market today. I would be more comfortable to look into each and every one of them and see which one has the highest holding of gold, because sometimes these gold unit trusts, while the name is gold, they tend to hold gold, silver, and other precious metals. It's not their fault at sometimes, because when you mine for gold, sometimes you tend to mine at the same time there's some silver in it or whatever. So it's again a part and parcel of it. And sometimes it's a conscious effort to have several different types of mines. So if you're just purely looking for gold, I would try and look into the various gold unit trusts and make sure that when I invest in one, it has a high component of gold allocation to gold mining companies.
Yeah, please share and like our page, and like this talk show as well. I hope that we can hit 300. Now we have 280 plus already. So, do you think there will be a bond bubble in 2021 or 2022? From Kelvin Yo.
Yeah, there is already a bond bubble which the Federal Reserve is struggling to contain. If you look at how bond prices reacted, bond prices all came down in February and March. The ones that recovered are the triple A's, the double A's, the A's. The one that is still struggling to recover is the triple B, slightly better, but the junk bonds are also struggling to recover. So the big question is, why are the triple Bs and junk bonds struggling to recover? The fact of the matter is, throughout the past 6, 7, 8 years when interest rates was extremely low, many companies in the triple B space came out to issue bonds. People whom were not very strong. You know, if you understand ratings, triple B just sits right on top of that borderline where if you go down, it's already junk bond status. So these companies are barely into the investment grade, the first level of investment grade. Okay. So basically, they've issued a lot of bonds in order to raise money, and successfully they have raised money because everybody was looking for yield. Oh, you are a triple B company, you never really made a lot of profit. It's okay, I'll still lend you money. Why? Because better than me putting it in a bank, you know, that kind of thing. So these companies got so much money, issued so much bonds. So there's this huge amount of triple B, and this is the crisis that the Federal Reserve is trying to put its finger to plug the hole now. Okay, there's this huge amount of triple Bs in the US. Okay, in any typical recession, 10% of triple Bs will drop into what we call junk status, double B. This is normal recession. These are statistics backed by statistics. Because as you know, as a recession comes in, some of these companies may not be able to sustain, and then they drop one notch lower. Okay, and when they drop one notch lower, it goes into junk status. So basically, right now, we don't know, and we don't think it's just going to be 10%. We think it's going to be maybe 20% or 30% of these triple Bs dropping into the junk market. And when you look at the numbers, and I don't have the numbers here, and it's on one of the YouTube videos, okay? When 20 or 30% of triple Bs drop into the junk status, it could amount to maybe 1/3 or even half of the junk market. Wow. What I mean by this is, we could see a huge supply of bonds dropping into the junk market and over flooding the junk market. Two repercussions. One, junk bonds are just going to be killed because now oversupply. Two, if you're holding on to a triple B and especially a triple B minus bond, and it drops into junk status, your price is going to be slashed almost immediately by 20-30% because it's a downgrade into investment, from investment to non-investment grade. If you had bought into a bond fund which has a huge amount of triple Bs sitting right at the triple B minus category, why would the fund manager want to do that? Because yields are higher. But now suddenly that huge amount drops into junk status. If that fund is an investment grade fund, he or she, the fund manager, would have to sell off those bonds that was investment grade, but now is junk status, and that particular bond fund would probably suffer quite a lot because suddenly 20% of my holdings become, I cannot invest in them. I have to throw them because it's no longer investment grade. And when I want to throw them, prices are really bad because junk markets are all flooded. So these are some of the risks people really have to understand. And sometimes as a layman, I feel that it's very difficult. So you need to really get an advisor or someone who knows about it to really look into it, look into your portfolio and pinpoint, hey, actually you're holding on to this while the name is investment grade bond. Guess what? The majority of bonds are held in triple B minus, because you can tell from the fact you need to be extremely careful. Are you okay with this? If it's not okay with this, then let's do something about it. So these are things that you really need to go into detail to find out.
Okay, Sunny, yes, because
it's very technical. So sorry.
Because of time, I think
that's fine.
So, if let's say you think this session is pretty good, can you give Sunny number 5? Give Sunny 5. Sunny 5. Put this right 5. Give him 5, so that he know that you have benefited from the session. Give him 5. Give Sunny 5. And I just want to pull up this information that we are going to have seminars on the 30th of April. You can scan the so-called the QR code there. Currently, we already have about 220 people already registered for the seminars, and we will actually also invite the other investment director, Victor Wong, who also have been in the industry for many years. He used to be a fund manager before, and also with the company with Financial Alliance for many years. And together with Sunny, both of them are running our investment team. So Victor is actually specializing in selecting the fund into the portfolio. So both of them will meet very frequently in looking into the portfolio. So both of them will be the speaker for the seminars on strategies and investment opportunity in this COVID-19 crisis. And they will also share with all of you about the market recovery portfolio 2020 that we were like Sunny mentioned just now, that it's good to go into a portfolio for maybe 18 months, that you use the dollar cost averaging strategy to go into the market to tap into any opportunity ahead of us. But if let's say there is a downturn, at least your risk is actually managed according to the strategies. So if you're keen to actually know more information about this, please scan the QR code. We will have the seminars on the 30th of April, and it's Zoom, either Zoom or another platform for the webinar. But we'll send the link to you probably on Monday or Tuesday. So we hope that you can actually scan and register for the seminars. So Sunny, before we end the session, do you have any other final advice to our client, our viewer about the market and also the investment opportunity?
Yeah, so I guess my parting remark would actually be, it is really unprecedented times, and therefore sometimes you get sucked into the notion that it's no different than the last time. Buying on dips is the way to go, or maybe selling, whatever the case is. But I would actually highly recommend that you sit down with your financial advisor, because sometimes a third party will be able to tell you, and me as the investment director, we educate the financial advisors at Financial Alliance in order to tell them where are the risks, how to pick up these kind of things and stuff. So they will be able to sit down with you to identify which part of your portfolio is over risky, which part is so on and so forth. It doesn't necessarily mean that you need to follow the advice, but basically we're here to give you our advice and information. At the end of the day, if you follow it or not, then at least we've dispensed our responsibility. I think that's important, because you need a lot of kind of a different view and angles. Like I mentioned a few things here, I think some of you may not have thought of it from a certain perspective, but these are the things that you really need to think of. It's no longer very straightforward, one way up, one way down. It's a lot of things to take into consideration. So please, I think it's a good time to engage your financial advisors to review your portfolios and your strategies.
Thank you, Sunny. So with this, I hope that you like this session, and if you really want Sunny to come back more often to this talk show, please put number 8, so that we can make it. So 5 is to thank him. Number 8 is to say that you want Sunny to come back maybe more often, or maybe even when there is certain triggering events.
Do like our YouTube videos also. Do
like our YouTube video as well. We have our YouTube channel under Financial Alliance. Sunny have actually conducted many sessions for closed session for our client, and he have video it into a YouTube video that we can go to. I think easily about 8 to 10 video now, right?
So basically, our YouTube videos, we have 2 sets. One is available for public, and I've talked about many topics. Gold, bonds, outlook and stuff. So those are publicly available. Every 10 days or so, we do client events, and these are meant for our internal clients. These videos are not available to the public, but if you missed it, you are able to get the link from your financial advisor, who will be able to give you the link so that you can actually just sit down and listen to our thinking and how we view things. And those are available. We have about 4 or 5 of them since the start of the crisis. We've been doing it. So there are 2 sets of YouTube videos you can watch.
Sunny, this month is actually, I think 2 days ago, the fasting month started. So Sunny is actually in the fasting month. So thank you so much.
No problem. No problem.
Month, you're still, energy. I know that I'm doing training as well, and you need a lot of energy to do this. So thank you so much for your time and also your effort. Share your insight to all the audience. So all the audience, thank you so much for your time.
Thank you everybody. Thank you.
Now there are 32 of them is still with us. So thank you so much, and we shall see each other again very, very, very soon, and hope that we'll see you at the webinar on 30th of April as well. Thank you so much. Bye.
Yeah, stay safe, everybody. Bye-bye.
Bye.
Through proven techniques, Financial Alliance has gained a secure foothold in the competitive financial services landscape in Singapore.
The Financial Alliance aims to actually be the leader in terms of giving independent financial advice, not only in Singapore but in the region itself.
Financial Alliance is a financial advisory company, but we don't just stop at planning and advising the client. We walk the journey with our client. And at the end of the day, we are also acting as a catalyst. We make a difference to the life, especially the financial life of our client and their family. And together, we achieve financial success.
Financial Alliance is about the client. It's about providing the client with the best possible financial advice.
We want Financial Alliance to be seen as a guiding star in the eyes of our clients and an inspiration for the financial advisory industry.
Diverse in our talents, allied in our beliefs, balanced in our techniques. Your lifelong companion in navigating your financial future. Financial Alliance.